Welcome to the Savvy Investor, where it's our job to help you be secure in any economy. Today we're talking about one of those little things that really puts the fear into every retiree, the possibility of going broke paying for long-term care.
Welcome to the Savvy Investor. Each week, the Savvy Investor helps viewers just like you create and grow wealth, protect and preserve it, and distribute it in the most tax-efficient manner while alive and after you passed. Our goal is to make you a better informed investor that hopefully leads to better results, but certainly less risk along the way. You can have financial security in any economy. Today is the day you can take control of your financial future and eliminate worry about your retirement forever. And now, the Savvy Investor with your host, Michael Canet.
One of the biggest fears retirees have is outliving their money, and the fact that the biggest expense we're going to experience as we get older is the cost of healthcare, and more specifically, the cost of moving into an assisted living center or a nursing home. You can easily spend $100,000 a year just to get the quality and service you want and deserve. Today we're going to talk about how to pay for that without going broke in the meantime. But before we go there, let's take a look at what's going on in the news. So let's take a look at the news. A great article from the American Association for Long-Term Care Insurance. They're talking about the length of stay, and here's some interesting information. If you're over age 85, 1 in 4 of you are going to be in a nursing home for 4 to 5 years. Now that's different than what they tell us, because in general, we're here, you stay there for about 28 months, but age 85, you're there for 4+ years. Keep in mind, it can be a little misleading when we say that, because it really is determined about, are you a man, are you a woman, and how old you are when you enter into a facility. For example, women age 84 and older, they're going to spend 5 years or more on average. Men 85, less than 3. But the bottom line here is averages are really kind of meaningless when you're planning for long-term care, because chances are you're not going to be average when you need that care. Now, a next article we have here from MetLife. Again, just another survey about the cost of being in a nursing home. And this is going to really astound you. It's going to be surprising. The average cost of a daily rate in a nursing home is well over $248 a day. And if you add that up, if you think about it, $248 a day, that's $90,000 a year, and that's on average. The question I have is, how quickly are you going to deplete your savings at $90,000 a year? How's it going to impact your spouse? What about your heirs? Did you plan on leaving them a legacy? And finally, we have an article from the Dallas News, and they're talking again about how devastating expenses can be, and in order to minimize this devastation, you need to have a conversation. Now, if you are a retiree, you need to have a conversation with your kids. If you're a child with a parent who might need a facility, you need to talk about this with your parents. And the fact is, it's a very difficult conversation. It's very emotional. It speaks to the fears that our loved ones are growing older and the health is deteriorating. But the fact is, there's important information that you need to share with your kids, and your kids need to be aware of. There's important decisions to be made, and by having an open and honest conversation ahead of time, it makes their lives easier, your life easier, and you do need to handle this in a delicate manner, but it needs to be done. So have the courage to sit down and have that conversation with your kids, with your parents. Now, on today's show, what we want to do is we want to better understand how these things are going to work, and most importantly, how are you going to pay for this without going broke in the meantime? We're joined by long-term care expert Michaela Sharpe. She has over 10 years helping people just like you protect their assets from the high cost of a nursing home. Now, we're going to take a quick break. When we come back, we're going to jump into protecting your assets.
If you're in retirement or retiring in the next 3 to 5 years, you must read Michael Canet's best-selling book, Surviving the Perfect Storm. Best-selling author and National Quill Award winner, Michael Canet's Surviving the Perfect Storm is a must-read to prepare for your golden years. This amazing book can be yours absolutely free, but you must call 800-787-SAVVY. Supplies are limited, so be one of the first 25 callers to receive your free limited edition autographed copy of Surviving the Perfect Storm. Call 800-787-SAVVY. Join the host of the nationally syndicated TV series, The Savvy Investor, and best-selling author Michael Canet for this very important, life-changing workshop. Michael and his team of advisors from across the country have been helping families create and live the retirement they envision by carefully crafting a retirement income plan that can withstand any financial crisis. Michael will give you the tools you need to make sound investment choices and help you prepare for your golden years. At this workshop, you will learn more than just where to invest your money. Michael will also share tax strategies that can save you and your family thousands in tax dollars. You will learn important estate planning techniques that can help you avoid the high cost of a nursing home, as well as reduce or completely eliminate any estate tax. Now, you can join him in person for these very informative workshops. They could be the answer to creating a safe and secure retirement you deserve. Call 800-787-SAVVY to see if you qualify to attend one of these workshops with best-selling author Michael Canet, host of The Savvy Investor.
Welcome back to The Savvy Investor. I'm your host, Michael Canet. On today's show, we're talking about long-term care and the cost of being in a nursing home. Now, they tell us all the time that the average cost is about $90,000, and a person stays in a nursing home for about 3 years. Now, I think those facts and circumstances are going to change in the near future as baby boomers start to move into the facilities. But the question remains, how are you going to afford to pay $90,000 a year? What impact is that going to have on you, your spouse, your heirs? And today we're joined by Michaela Sharpe. She's an expert. She spent over the last 10 years helping families just like you protect your assets from the high cost of being in a nursing home. And being blunt and candid about it, we really are talking, I mean, a lot of times we dance around the whole idea about going into a retirement community and being in an assisted living in facilities and stuff like that. But what we're really talking about here is the fact that you're going into a nursing home. And I just want to be blunt about that because people are afraid to talk about it. And I think that happens lots of times. You know, kids and parents don't have this conversation.
It's a tough conversation. It's certainly not had because it's typically the parent, no matter how old they are, they don't want to have that conversation because I think largely they're in denial. It's not going to happen to me. Maybe it happened to my parent, but it's not going to happen to me.
And I think to some extent, although I will acknowledge my mother-in-law, I've been practicing law for 20 plus years, and she refused to sign a will because from her perspective, as soon as she signed it, it meant she was going to die. But I think kids have an obligation to broach this subject as much as mom and dad don't want to have this conversation. Kids have an obligation to broach this with their parents, wouldn't you think?
Well, they certainly should because otherwise it becomes crisis management.
Well, that's in fact what it always is, right? And what are the facts and circumstances that we find ourselves in when we actually have the conversation? Because it's not until what happens. They wind up in a nursing home.
They wind up in a nursing home or they can no longer stay at home by themselves because of the dementia, because of the Alzheimer's. And now the money may or may not be there to be able to pay for that care. And that care is typically not paid for by social programs like Medicare, if you will. So it has to come out of assets, and nobody likes to spend their own money on care.
Right.
Or the kids have to pitch in order to help out. But the kids are working. They have their own families. So for most people, when do they find themselves in a nursing home? It's not they just volunteer to go in. I mean, there are very specific occurrences, like you said, dementia. They develop and they move along the dementia trail. Alzheimer's continues on. But for what I see frequently is people coming into a hospital because they've had an accident of some sort. Oftentimes a stroke.
Oftentimes. And then when they're moving out of the hospital, they go to a rehabilitation center, and then what happens?
Well, they're in rehabilitation, and Medicare is paying for some of that, but then they exhaust their Medicare days, and they still need care. They can't be released to go home because oftentimes no one else lives at home, or it's an elderly spouse that can't provide the care, so the doctor won't release them to go home. So they perhaps end up either in nursing care or assisted living care.
So let's talk about the cost and going into a nursing home. First and foremost, going into the nursing home, it is an emotional, very, very traumatic occurrence for the kids and mom and dad as well. I mean, so it's traumatic across the family, which is why you said you need to have this conversation. Is there a point that most families should really have this conversation? What's an appropriate age that you start talking about the fact that, look, this is the reality of life?
I think many people, I like to think that people talk about retirement planning perhaps sometime in their mid-50s, and I think that's the time. I don't think that's too soon to be talking to your children about this topic, because people don't end up in nursing homes just because they're old and they have a stroke or they take a fall. Things happen when you're young as well.
Right.
It could happen when you're 55, it can happen when you're 60. I know quite a few people that have been diagnosed with Alzheimer's at very young ages, your age and my age.
Right.
I hope that, you have to have that conversation.
Which is why, we both agree planning across the board is important. And anytime you do planning, from the retirement to the risk mitigation, long-term care has to be part of it. And I think you're right. In your 50s and 60s, when you're thinking about retirement, typically you're having a conversation with your kids about retirement anyways, and talking to them about your long-term care options certainly makes sense.
It does, but I will tell you, one of the dangers of speaking to your children about this, and most people don't, but one of the dangers is the children are speaking from their heart, not their head. And they'll say, "Oh, Daddy, I'll take care of you." But let's really think about that. Is your daughter, your son, really capable of caring for you? Could your daughter lift you if you needed to be lifted? My guess is probably not. Let alone the fact that perhaps she's working for a living, she has a family to support, and she may have small children as well. How does she really make that happen? So when she says, "Oh, Daddy, I'll take care of you," that's the heart talking, not the head. Because if she were to reply to you, "No, Dad, I'm not going to take care of you," how does that make you feel?
Right.
So it's tough for it to be an honest conversation.
Right. No, that's a good point. That's a good point because, just like our parents took care of us, we want to take care of them. But the fact is, in today's economy, it's two working adults supporting a family. And,
Absolutely.
And for one of them, if they're going to take care of you, that means one of them has to give up the job. And that's a huge economic burden on the family as well.
Absolutely, that they did not plan for. I mean,
Right.
do you think that in a working family, couples, do you think they really talked about giving up a job in order to take care of a parent or an in-law? That
Absolutely.
conversation, it hasn't happened in my family.
Right. And you're in the profession, right?
And I'm
Right,
in the
right,
profession.
right.
That's right.
So the cost factor. Is 3 years a reasonable expectation? Do you think that still holds true in today's and going into the future?
The average amount of time that people find themselves in care, and when I say care, I don't necessarily always mean nursing care. Many people live in assisted living facilities. Some people get care in the privacy of their own home with paid caregivers coming in.
Right.
That whole period of time, on average right now, approximately 3 to 3.5 years. That number keeps going up because people are living longer, not always commensurate with quality of life.
Right. And what about the cost? To be in a reasonable care facility is $90,000. I mean, MetLife threw out numbers in the $90,000 range. I mean, in Des Moines, Iowa, they said 65, and in Manhattan, they said 162.
Absolutely.
But
Absolutely.
90 is in the right neighborhood?
90 would get you into what I would consider to be a decent residence. Yes,
Right.
$90,000 a year.
So-
But that price keeps going up.
Absolutely.
Definitely outpacing the consumer price index, no doubt about it.
So now that we know, on average, about 3+ years, the numbers I see, about 25 to 30% of us are going to need care. Is that reasonable?
Larger.
Oh, there we go.
Larger.
Even worse than I think it is. So bigger percentages of us are going to need care, 90,000 plus a year, 3+ years to be in a facility. When we come back, we're going to talk about how to pay for that expense. You're watching The Savvy Investor, and we'll be right back.
If you're in retirement or retiring in the next 3 to 5 years, you must read Michael Canet's best-selling book, Surviving the Perfect Storm. Best-selling author and National Quill Award winner, Michael Canet's Surviving the Perfect Storm is a must-read to prepare for your golden years. This amazing book can be yours absolutely free, but you must call 800-787-SAVVY. Supplies are limited, so be one of the first 25 callers to receive your free limited edition autographed copy of Surviving the Perfect Storm. Call 800-787-SAVVY. Join the host of the nationally syndicated TV series, The Savvy Investor, and best-selling author Michael Canet for this very important, life-changing workshop. Michael and his team of advisors from across the country have been helping families create and live the retirement they envision by carefully crafting a retirement income plan that can withstand any financial crisis. Michael will give you the tools you need to make sound investment choices and help you prepare for your golden years. At this workshop, you will learn more than just where to invest your money. Michael will also share tax strategies that can save you and your family thousands in tax dollars. You will learn important estate planning techniques that can help you avoid the high cost of a nursing home, as well as reduce or completely eliminate any estate tax. Now, you can join him in person for these very informative workshops. They could be the answer to creating a safe and secure retirement you deserve. Call 800-787-SAVVY to see if you qualify to attend one of these workshops with best-selling author Michael Canet, host of The Savvy Investor.
Welcome back to The Savvy Investor. Today we're talking about long-term care, nursing homes, how to pay for it, $90,000 a year, 3+ year stay. We're joined by Michaela Sharpe. She's an expert. She spent over 10 years helping families just like you figure out how to pay for the high cost of nursing homes. Now, before we go and continue our conversation, I want to do a little bit of viewer email if we could.
Sure.
And we have a couple pieces here that I think are just right on point for today's conversation. We have a Stephanie from Middle River, Maryland, and you addressed this briefly before, but what Stephanie's talking about here is that she wants to know how much Medicare covers. And I think this is a big thing that people don't understand, but explain to us, to Stephanie, what about Medicare? What exactly does it cover?
That's a great question, Stephanie, and a very brief answer to it. Medicare is not a long-term care insurance program. Think of Medicare as a health program, which is what it is. It's the insurance that will get you healthy, keep you healthy, and provide you some rehabilitation. Some rehabilitation, but that rehabilitation is limited, and it is predicated on you responding to it and getting better, but it's limited, typically about 100 days.
Right. And what I see, for Stephanie, what we typically see in my practice is that when mom or dad have gone into a facility, they've gone into a hospital and they've been released to a hospital, into a rehabilitation center, and within pretty short amount of time, very rarely do I see 100 days.
Rare.
Usually within a week to 2 weeks, the rehabilitation center is saying that we are now providing palliative care, which Medicare covers 0 of, or mom's getting better, and they're trying to push mom and dad out of the rehabilitation center just like that.
Absolutely.
So Medicare is not the solution to this particular problem.
Absolutely not.
Great question, Stephanie. Now we're going to go to Michelle in Kissimmee, Florida, and actually this is perfect. This is a perfect question for us for today's topic. She's turning 55 this year, and she works with an advisor down in the Orlando area, and he's trying to convince her to buy long-term care now, and I think she thinks 55 is too young. So is there the perfect age to buy long-term care insurance if you're going to do that?
I don't think there is a perfect age. The important point to remember is that in order to qualify for long-term care coverage, an insurance company is going to make sure that you're healthy. And if you're not healthy, they're not going to offer you the coverage. So you don't know, today you're healthy, you don't know what tomorrow brings. So I say to the caller, at 55 years old, absolutely do it, because at 56, you may not have your health. And we don't want to be lulled into thinking that a long-term care event is only for old people, because there are many people that are residing in facilities today that are in their 50s and their 60s because automobile accidents, motorcycle accidents, boating accidents, early diagnoses of Alzheimer's dementia. I contend that no matter how old you are, you should be looking at it. You should be looking at it now, again, because you don't know what your health situation will be tomorrow.
And really, Michelle, it's part of any true financial planning. You want to sit down and you want to look at all aspects of it. And the whole idea of how you're going to take care of long-term care issues, if your advisor is saying long-term care insurance is the right solution, then you want to buy it when it's the best price, which typically is a little bit younger.
When you're younger.
When you're in the best health, which is typically when you're a little bit younger.
A little bit younger.
And so 55 may feel like too young. And I think, and I want to come back to this a little bit later, I think some people are opposed or object to buying it too soon, if at all, because they're going to pay for something that they may not need. And that's the big thing. And I want to come back to that because to me, I just don't get that whole philosophy. But so great questions. We appreciate the email. Let's talk a little bit about how we pay for it. Because there's, for people that are faced with the fact that they're going to be going into a facility at some point in the future, we got to pay for this. And at $90,000 a year, what are our options?
Well, your option is to self-pay.
Okay, so pay it yourself.
Pay it yourself. Count on your children to take care of you.
Okay, so we're going to discount that. That's a bad idea.
Right,
so we're just going to
exactly.
discount that. Don't do that. So private pay, move in with the kids.
And then if you find yourself indigent because you spent down your assets, then there's a Medicaid program out there.
Make yourself broke and let Medicaid pay.
And your other option would be to secure long-term care coverage.
Do what Michelle's thinking about and buy long-term care.
Absolutely.
Okay, so make yourself broke. Spend all your money making yourself broke because you pay for a facility and you wind up staying there longer than the 2 or 3 years that you think you're going to be there. Move in with the kids, again, bad idea. Or buy long-term care. So let's talk about long-term care. You know, Michelle brought up the point that, you know, she's 55 and thinking about buying it, and I mentioned the fact that for a lot of people, when we're doing our planning with them, they're always concerned about, why would I buy long-term care? Why wouldn't I just self-insure? So why wouldn't you self-insure first?
It's a very costly way to pay for long-term care services. Many people are going to find themselves in care. Earlier, I think you mentioned the number 25%. In actuality, that number is much higher than that. For females that make it to age 65 and beyond, their probability of needing care is on the order of about 70+%.
So 70% of the women over age 65
will find themselves in care. I'm not saying a nursing home, but I'm saying in care.
but paying for somebody to help out along the
Yes.
way somewhere, someplace.
Absolutely. And for males, the number's a little bit better. For males, probably on the order of about 40-some%.
And it's interesting that you say that because the conversations we have constantly, and I'm sure you have similar conversations, is that, you know, wives have a tendency to keep their husbands and take care of their husbands much longer than they should, to the detriment of their own health.
Their own health, absolutely.
And then the husbands are quick to say it's more than I can handle. So having a plan to pay for it, again, at $90,000 a year, that's a lot of money. Even having somebody come in the house is going to cost you close to $90,000 a year. So let's talk about long-term care, and let's approach it from the perspective of, I'm paying for something that I might not use, because that's what I hear all the time. Why would I buy it? I might not need it.
But Mike, what about people that buy homeowners insurance? Most people never touch their homeowners insurance, but they don't seem to complain about paying for it.
Are there auto insurance or anything?
Auto would be another one.
You know, I had a conversation just the other night with one of my clients, and we were having this conversation about long-term care, and he said, why would I pay for it? I can pay for it myself. And his name is Carrie. And I said, Carrie, you know what? I happen to know you have more than $500,000 sitting in a savings account. Why do you have homeowners insurance? Because you could pay for your house if it burnt down.
Absolutely.
And his response was, it's so cheap to have homeowners insurance, why wouldn't I transfer the risk to them? But that's exactly what you're talking about.
And the reason why the homeowner's insurance is relatively cheap is because the probability of that being a big claim is infinitesimal compared to the probability of needing long-term care services.
Right.
Again, you're talking 40% as a male, 70% as a female. The probability of your house burning down, I think it's probably less than 1%.
Right.
So that's why you're going to see a difference in price between insuring your house versus having long-term care insurance.
But the fact remains is that we transfer risk
All the time.
For almost everything we do. Whenever we can transfer the risk to somebody else, we do it. And this is the one piece of the puzzle that has always confounded me, that we don't pass the risks to somebody else and let them absorb it. Now, how expensive is long-term care? I mean, how much should a 55, Michelle, how much should she expect? Assuming she's in reasonable health, how much should she reasonably expect to pay?
I'm just going to throw out a number, but she should expect to pay somewhere between $200 and $300 a month for decent long-term care coverage. Certainly, it could be less, but if you pay, you get what you pay for in this business.
Right.
If it's less, it won't be quite as much coverage, but maybe through the discussion she might have with her children, a smaller policy might be very appropriate because maybe she's planning to live with her children, and maybe she can use this policy just to bring some care in to her child's home to assist her. So that might work beautifully.
And it's really facts and circumstances. Health is going to play into it.
Sure.
How much you need is really based upon what your other assets look like and your income. Now, how much do you guys recommend? How much would you recommend the typical person have in coverage?
It depends on where they live, because depending on where you live in the country, it's going to be a very different cost for those type of services. But typically, we would recommend that they have available to them in today's dollars about $200 a day to offset the cost of care.
Plus inflation?
Absolutely, plus inflation.
Right.
You can't miss that piece, because if you're 55 today and you don't need the care until you're 80, that $200 a day is not going to do very much for you.
Right.
You have to have that inflation component in a good policy.
And I see policies for 3 years and 5 years. Is there a recommendation?
I would say for males, maybe a 3-year policy is probably adequate. For females, I like to see about a 4 or 5-year program.
Because typically women are going to be in there a little bit longer.
Absolutely.
So some great information today. We know it's going to cost you on average $90,000 a year. And for the women out there, 70% of you are going to wind up needing care at some point. Have the conversation with your kids. It's important. Kids, have the conversation with your parents. You're watching The Savvy Investor. We'll be right back.
Now keep in mind that just like any tool, there's the right tool for the right job and a wrong tool for the wrong job. We've just scratched the surface here, and you'll want to know more about how today's conversation might or might not fit your needs. Ask about fees, surrender charges, market risk, interest rate risks, how the guarantees work, liquidity, and much more. Remember, the right tool for the right job.
Today we're joined by long-term care expert Michaela Sharpe, and she gave us several takeaways from today's conversation. First and foremost, you need to be delicate when you're having this conversation with your loved ones about long-term care. It's a very emotional, very scary time for them as well, so be delicate when you have the conversation. The second takeaway she gave us, and I think this is an important one, don't wait to the end to have a conversation. Don't wait till they have to go into a nursing home to have this conversation. You need to plan ahead of time. And from our perspective, planning somewhere between 75 and 80 is a great time to start planning for this. Now, the third point that she gave us, and I think this is an important point, at $90,000 a year, you have to have a plan because it's very, very expensive. And if you plan correctly, you can control the cost of being in a nursing home. Now, I want to thank Maddie for joining us today and giving us some great insight into a very, very difficult subject. If you'd like our free guide to long-term care planning, call the number you see on your screen. It's a step-by-step guide to help you make smart choices about your money and the costs associated with a nursing home. Give us a call and we'll send out our guide at no cost to you. If you'd like more information on today's show or would just like to secure your financial future, call us and we can get you started on the path to financial freedom. Next week on The Savvy Investor, we're going to talk about fees that you are paying. We'll see you, The Savvy Investor, next week.